So the FOMC meeting is this Wednesday. There's a lot going on in the market. Interest rates are impacting a lot of different industries, including crypto, banking, cars, and in general, what we see in real estate is not looking too pretty because we don't know which direction it's going. So we're about to break all that down right now. So make sure you stay tuned because at the end of the episode, we're going to show you a tool that basically indicates what the Fed's about to announce on Wednesday. So let's get into it, bro.
Yeah, for sure. So I'm about to share my screen because we got some links we want to show y'all. It's going to break down a lot of what we want to get into. So first and foremost, I want to start with these charts right here, bro. I know a lot of you are not like used to looking at charts, and that's okay. I'm going to make it nice and easy for you to understand. So right now you're looking at the price chart of Bitcoin because I wanted to bring up crypto because everybody's been talking about it lately. Everybody wants to know like, yo, should I get into crypto? Is it back? I will say this. All the crypto haters, they getting a little quiet, right? Nu, have you been hearing a lot of crypto haters lately?
No, you know what's funny? Everyone who was like, oh my God, it's about to go down. Y'all were all chatting, blah, 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 blah. I mean, now they're the quiet ones. So, hey, I don't know what's going on, but that number looks pretty good to me.
Yes, it looks pretty good to me. Bitcoin has been very impressive. Bitcoin, as of the time of this recording, has hit like well over 27,000. And what I would say for you guys to know is if you see this line, right, as it goes down, that means the price is going down. And as it goes up, that means the price is going up. So green especially is a good thing. Like green is showing you that price is super going up. So as you see like recent price action, every what we call candle represents a day of price. So as you see these green candles, this is multiple days that Bitcoin is going up. And it actually breaking over this white line was very, very important because this white line was a place where every time price went there, it rejected. Look, see, price would come up, reject it, and come right back down.
Yeah, what he means by rejecting is basically every time it would go there would be a sell-off. That's all that means. People will get to that price, and then you would see that price come right back down to what he's showing right now.
Yeah, literally. Thank you for saying that. And then lately, as you see recently, Bitcoin broke over that level. So we want to see what comes next. What I expect is us to revisit this area at maybe right here at 25,000, maybe even a little lower, and maybe go right back up. So that's what I'm watching for on Bitcoin. And I also want to show you guys the 200-day moving average because we brought this up on the show before. But what this is telling you the rolling average price over the past 200 days for whatever stock or crypto you're looking at. And so what you can notice is the 200-day moving average is this blue line right here. And just visually, all you have to know is usually if a stock or crypto is trading above the 200-day moving average, you can expect prices to go up pretty steadily. Once it comes below it, prices tend to drop pretty rapidly. So as you see even here, right? Like once Bitcoin came below its 200-day moving average, it pretty much just traded below it for so long, bro. This is when it dropped here. This is, let's see when this was in history, bro. They got all these ads on this website. This is December 2021, and it's been below there all the way up until recent price action. We finally broke above the 200-day moving average. We retested it, and then we're continuing to move up. So that's a good sign for crypto. So for people saying, hey, should I get into crypto? Newski, what's your take on should they get into crypto right now?
Yeah, so I would always urge people to do this, right? Like we talked about this multiple times. You do want exposure to the markets and when it comes to crypto, right? Like, so Bitcoin obviously is the safest one to rock with because it is the biggest when it comes to market cap. So my approach is, yes, I think you should get into it, but I don't think you should dump in a lot of your money in one place. So for example, if you have $10,000 to invest, or even if you have $1,000 to invest, I wouldn't put all that into at this price, right? Like it just wouldn't make sense to me. I would continue to invest on a weekly basis because now you're taking advantage of it. You're not thinking about, ooh, maybe I bought too soon. I have no more capital left, right? So that's why I think it's, yes, you should invest in crypto, but you shouldn't invest more than the percentage you feel safe. For me, that percentage is way different than your percentage. We always say, do what you feel comfortable.
Yeah, bro, and I couldn't agree more, bro. Like, I think it's good to not put big chunks in because there's a lot of uncertainty, which we're going to be talking about throughout this episode. There's a lot of uncertainty in the market right now for all industries. So you don't want to go too crazy. And just to show you, like 200-day moving averages, when it comes to the stock market, we dropped below that in like 2022, and then we traded above it. Right. So it looked like we were about to enter a bull market. Remember, just in January, things looked really bullish, as in like stock prices will potentially go up. And then what happened recently, we dropped right back below that 200-day moving average. We retested it and we potentially might break back down. This, as of this recording, that's where we are. So we'll see what Monday holds as far as whether we could break back above the 200. But so the stock market went below it, crypto went above it. And so it's a lot of uncertainty there.
And I think a lot of this is happening with what's going on with the banking news, right? Because when banks were trying to get all caught up in the whole Silicon Valley stuff, which we have explained, so you haven't checked that out, make sure you do so. A lot of stuff was happening where they weren't sure with our banks safe, what's happening with interest rates. So, well, you want to click on some banking articles that we have so we can talk about that as well?
Yes, most definitely. So, man, you were spot on, because that's literally why I personally think crypto has been pumping. We've seen a lot of people losing trust in the banks. On top of that, there's a potential that Jerome Powell might have to decrease interest rates a lot sooner than later. And that right there is sending assets like crypto pumping, because that's really good for something like crypto. They would love to have a low interest rate environment. And on top of that, like I said, you see this article, why are people worried about the banks? So we've just seen the whole banking collapse come, because what it is you guys have to understand how banks work. So to just really summarize what this article is talking about and what we talked about on our recent episodes, so definitely check that out with Silicon Valley. But banks, they take everyone's deposits, especially like these small businesses. So these regional banks, they work with small businesses a lot. They take their deposits, and the way that the bank makes money is they lend it out. But not only do they lend it out to make money, they also buy bonds to make money, because bonds are going to yield them an interest rate that's some pretty guaranteed money for them. So that's the way that banks make money. And what happened was, there's a lot of banks right now that the bonds that they bought back in 2020 and 2021, they bought those bonds in a low interest rate environment. So it's tough, because around now, when their deposits have slowed down, because people are not putting money into the bank as much because they're not making as much, especially, you know what I mean? Especially like small businesses in the environment that we're in. So their deposits have slowed up. The banks are thinking, man, we have to have a certain amount of cash on hand. We need to liquidate some of our bonds so that we could get some cash on hand. And then so when that happened, they're liquidating their bonds at a price that is not too good, because the bond prices have dropped because interest rates have risen. So if interest rates are high right now and the bank owns a bunch of bonds with low interest rates, then their bonds are not worth much. So they have to sell them at a loss.
Yeah, and this whole, guys, just to like think about it, right? We explained it pretty well in the last episode. So I'm going to try to do the same thing right now, where it's just think about it in very simple terms. Interest rates determine a lot when it comes to banks. They determine basically everything. So when banks are making money, it's great. But as Raul said, the banks are not making as much money, aka they're not getting as many deposits, because since interest rates are so high, businesses are not thriving as much anymore. Their margins aren't as good anymore. So their margins aren't as good, they're not depositing as much money into the banks, which is why the banks are struggling, which is why the banks have to sell the bonds that Raul was just speaking about at a terrible price. So that's why this whole thing's going on. But right now, as you can see, the sudden collapse of Silicon Valley Bank and Signature Valley is the biggest bank failure since the Great Recession. So it's not looking too good when it comes to banks, which is directly actually going to impact the mortgage rates as well. So I think all of this kind of ties into one thing right now.
Yeah, and we're about to get into mortgage rates. I just want to point out like how the Federal Reserve has stepped in to pretty much help the situation. So you guys know the problem. Newski just did a good job breaking it down. But just understand the Federal Reserve, what they're going to do is they're going to rescue the banks, quote unquote. they have to step in, and they made a program to where they're going to pretty much be using the bank's bonds as collateral, and they're going to be loaning the Federal Reserve. They're loaning all these banks that we know about money, and that loan is going to last 1 year, and that loan has interest. So let's think real quick. These banks are now going to be under a loan. That loan will hold them down right now. That way they're not insolvent. But next year they have to pay that money back. So we pretty much kicking this can down the road, which is pretty annoying.
And the thing I want to make a point on right there, bro, is that for a lot of people who don't understand the Federal Reserve, I want you to think about them as the OG. Like, they're literally the OG. So you have like the banks. Well, this is how you really have it. You have the regular people, right? Then you have the banks, which give money to the regular people. Okay, so now you got two levels. And then the OGs are the Federal Reserve. They are the ones who basically decide everything. They decide how all these certain levels below them get impacted. So when Rel is saying the Federal Reserve is giving money, this money is coming out of nowhere. Yes, it is being randomly printed. They had the ability to print money, which could then most likely impact inflation again. But that's not anyone's problem right now, because guess what? Banks will survive, which means profit margins will be better, which means people are going to have a happier life for the next few months, which is exactly what Rel is saying. We're just kicking the can down the road.
Yeah, and they have to do this because if the banks fail, that's going to be a problem that even bigger than inflation.
That's a hard landing, which Jerome Powell does not want. He wants a soft landing, right? So that's this whole narrative is kind of the approach that everyone's taking, like the soft landing, hard landing. What that really means is hard landing is terrible recession. We're going to be really screwed, et cetera, et cetera. Soft landing means, yeah, we're still going to get a slap on the wrist. It's going to be bad, but at least we're surviving and struggling. We're just not all dying. That's kind of all that means. So that's why his hands are kind of tied right now.
Hands are tied. And so people are starting to anticipate that he might have to actually cut interest rates based on what we're saying. And we're going to get into that. But let's talk about interest rates in the first place. So like Nusi was talking about with real estate, mortgage rates have been dropping amid these bank closure fears. So there's a lot of banks, there's a handful of banks that have closed down so far. Some other banks may be in trouble. Everybody's anticipating, because of what we just talked about, that the Fed might have to lower interest rates so that these banks could actually make money. Because like I said, guys, think about it. If these banks have to pay the Federal Reserve back next year, these banks need interest rates to drop. Because when interest rates drop, the bonds that they currently will have from buying newer, higher interest rate bonds, they're going to be worth more. So they can actually make money. So what the Federal Reserve is doing is giving the banks an opportunity to potentially make money, to stay on top. But the only way that is going to work out is if the Fed drops interest rates. So everyone anticipating the Fed dropping interest rates is why the mortgage rates have dropped. And so that might send things like home prices rising again. And so here comes an inflationary issue again, because, you know, shelter and home prices are the biggest things that impact inflation. And so if everybody is getting back into housing and things cost a lot of money again, there you go, bro. It's another tough time to get into real estate. You know what I mean? So
yeah,
it's tough.
And the thing is, man, like at the end of the day, I don't want this stuff to go over y'all heads, right? Like when you think about it, all this is very, very simple in the sense of the banks just cannot fail, right? Because if the banks fail, it's not going to be pretty. So the Federal Reserve will do anything possible to keep the banks going, which is why they would drop the interest rates, right? Because that is very important to the banks. And then as Rel said, interest rates falling is going to impact mortgage rates. Prices are going to go up. Inflation is going to happen. We're going to start complaining again about how we can't buy homes anymore. It's going to be literally kicking the can down the road. We're just going to keep on going in the same circle over and over again until something collapses. And that's exactly what we're about to talk about, essentially, right? Because at the end of the day, the reason why someone, aka Papa Powell, Jerome Powell, right, is going to decrease interest rates is because he's anticipating something is going to pop. Right? One of those things could be the car market as well, which is another scary topic. So I was just about to ask you, right? Basically, guys, the average auto loan interest rate now is 6% for new cars, 10% for used cars. That's if you have really good credit. I just want y'all to know that. And it even says it, with a credit score above 780, you'll have the best shot at getting a rate below 5% for new cars. So I will say I'm in the car world, and a lot of car prices have not moved that much. They really haven't, right? Yes, you're seeing a little bit decrease here and there, but since there is a chip shortage, car prices are not moving, and maybe some of them are going down, but most of them are actually going up because of that shortage that we spoke about. And then on top of that, interest rates are not looking too hot right now. So if they do decrease interest rates, right? The Federal Reserve does decide to decrease interest rates, then this will be good for the car market. But until then, it's not looking too hot.
Yeah,
This might be a bubble that pops.
Yeah, that's a fact. That's a fact. We've been keeping an eye on the car market for a while. You know what I mean? We've been keeping an eye on it. So it's like, y'all see how these interest rates have been impacting all these different industries. It's kind of interesting because there's been a lot of changes lately on people's expectations, and we can see that in the CME Fed Watch tool. And we've explained this tool on multiple episodes. So without really getting into it, just understand that this tool right here is what people use to see what the expectations of the interest rate rises will be from the Federal Reserve at their FOMC meetings. And as we said, there is an FOMC meeting this Wednesday, March 22nd. And so what they're expecting for this Wednesday is that the Federal Reserve is going to raise interest rates by 25 basis points. In other words, 0.25%. So that's what's expected. 62% expect that. There's actually 38% that are expecting the Fed to not raise interest rates, which is crazy, like outlandish, because just a month ago, 0% of people even thought that. That's like something that's unheard of, literally, you know what I mean? So, but they think that they're gonna raise 25 in March. Right now, the expectations is that they're gonna pause it in May, which is another change because we all thought that they were gonna raise it in May. And then they're saying that in June, they're actually going to potentially cut rates. Who in the world thought that the Fed would be cutting rates in June? That is unheard of. This is a very recent change, and it's extremely important. And it kind of goes back to what you were saying with the banks. The reason why people are anticipating this is because they know if the Fed keeps interest rates high, these banks will fail.
It's not only the banks, bro. It's not only, everything is going to fail. Literally, I'm telling you, like, it's not pretty. I just shopping for cars, and the people are legitimately saying it. Come back in 6 months, you'll be fine. Come back in 6 months, you'll be fine. Because the refinancing is going to happen. It's going to be a part of it, and people are expecting that. So it's right there in front of us, and you can't really fool the person who literally does this every single day. AKA, you can't fool the banks, you can't fool the salespeople, you can't fool real estate people. They know what's happening.
Dang, that's true. That's true. And guys, I want y'all to know, like, you know how I said that the Federal Reserve is going to be giving them loans. Remember, what would banks do with that loan from the Federal Reserve? They're going to buy bonds because that's how they make money. So just to clarify that, the banks are going to buy bonds now, and the bonds now have high interest rates. That's a really good thing for them to make money with. So now when the Fed decreases interest rates, the banks own bonds with the highest interest rate. Now they have the most valuable thing on the market. Like, yo, I got an interest rate of 5% on my bond. So when the Fed decreases interest rates, the bank, when they want to sell their bond, they're going to get a lot of money for it because people will pay a lot of money for a high interest rate bond while the environment is low interest. Understand? So that's kind of why I say that the Federal Reserve has to decrease interest rates so that these banks can make money to pay their loan back next March.
Yeah, and that might be a little confusing for y'all. So if we were listening, I get it, it's a little confusing, but just think about it in very layman terms, right? If you're a bank and you're giving someone interest rates and you give them a 5% interest rate, right? Okay, cool. They might be happy because, oh, it's lower than the market right now. Completely get it. But then if they get a 10% interest rate and that is giving them a better return, like the bank is giving them 10%, the bank wants that 10%, right? They get more money back. The same thing kind of fluctuates when it comes to bonds. You want a bond to give you the highest interest rate. That's all I was trying to say. You just want a higher interest rate because that means you're getting more money back. So if a bank has the ability to have making this number up, a 10% interest rate on a bond, when the actual market is giving like a 2% interest rate, the banks are winning, right? Because they have something that's going to give them a better return on their money. 10% is always better than 2%. Simple as that.
Yeah, when you're on the side of the one who's making.
When you're the person who's actually making money, not when you're the person who's the pay.
Exactly. And that's all we're saying right there. So that's why everybody's anticipating a decrease in interest rates potentially in June, or that's what the majority is saying. So it's kind of a crazy turn of events, and there's a whole lot of uncertainty because we saw banks start to fail recently. We don't know what's coming next, what's going to fail next. Nobody thought the banks would fail. Like, that was out of left field. So who knows what's next? And that's why we kind of say our message for the episode is like, we have to pay attention on Wednesday to what Powell is about to say on his future plans, because this plan where everybody thinks he might cut in June, based on what he says on Wednesday, might change. And that might change everything regarding the banks, real estate, crypto, cars. Everything is going to be affected based on what he might say on Wednesday. So you, as an investor, I suggest that you just continue to, of course, dollar cost average. Don't throw no crazy chunks in, because why would you throw crazy amounts of money into something that you have no clue where it's about to go? So we want you to just be conservative. It's not a time right now to go super heavy. Just be conservative and stay regular on that side.
Yeah, and I think literally nothing else to add besides just make sure that you're staying safe. You have no savings and check. That's all that matters, man. But if you're still here, you're still watching the episode, we thank you. Please make sure you like, comment, and subscribe to the channel. Plus, hit that little notification bell because we drop
2 videos a week.
You don't want to miss them. We appreciate you. Thank you. Make sure you check out our video on Wednesday. But until then, peace.
Peace.
Soundstripe.